the way the vacancies versus the demand is coming through, like there's a massive mismatch as to where the vacancies are versus where the major demand is as well. The character of the suburb matters a lot to, where the immigration is coming from as well. So it's a very important point. Demand creeps up over the next sort of 12 to 18 months as people start entering into the buying mode. I think a lot of people don't take lag into account. They think that they treat property market as share market, right? Oh, the rent goes up, the price goes up, whereas that's not really the case. Co-living properties can generate almost $140,000 in passive income and net of $40,000 in passive income after mortgage repayments, and they sit in an average yield of about 10%. Hello and welcome to another episode of Help Me Buy Property Podcast. Today's episode, we will discuss the RBS decision of interest rates and its implications as to why they're keeping it flat. We'll talk about the APRA's decision of keeping the serviceability buffer intact, but we'll also discuss the growth markets, the markets that we need to watch out for. But last but not the least, the trade secret at how to pick these growth markets and the impacts of these interest rate drops that are yet to come. We have our own in-house data scientist, the data guru, Mr. John Lindeman, who will be co-hosting with me today. Let's do a drum roll to introduce John and bring John in. John, how are you today?
Thanks very much, Milos. I'm very well. It's great to be here again.
Yes. Thank you for joining in again. And I think it's interesting times, John. We're talking about RBA keeping the rates flat. You're talking about APRA and you're not changing the serviceability buffers. And we are still seeing the markets changing quite dynamically in 2025. And so let's go right into the mix. Yeah, perfect. And so hottest place to look out for in 2025. Yeah, let's start there. Let's kick off. What do you have on the table for us?
What I've got, a number of things. I'm going to cover the National Housing Market Update using the latest CoreLogic data, look at our own capital city forecasts based on our patented database, and then I'm going to give you some boom predictions.
And for viewers and listeners, John is the only person that I know of in all of Australia who has a data model which is patented in Australia from predictive marketing, from predicting property prices. So he's a veteran when it comes to property market predictions, and he's been out there, talking about where the markets are moving, where the markets are heading. So over to you, John. Let's talk a bit about, national housing market updates and see where the markets are heading this month.
Okay, so nationally, let's look at the median value, and what I do here is I rank them. So Sydney is still the dearest capital city in which to buy a property. But Brisbane is second, and that's followed by Canberra. And then we've got Adelaide and Perth, and poor old Melbourne is still languishing in sixth place. But I don't think that's going to last very much longer. And then
I know, right?
Yes.
There is so much pressure that is building up in Melbourne right now. It's like crazy. And the funniest thing is this, right? The data has a lag to it. Like that's what I feel like every time you look at what's happening out. And I'm talking purely from median price perspective, right? People would look at the median price and be like, oh, I should pay X amount of money for this particular suburb, whereas the markets are moving so fast in certain pockets only. So it's not Melbourne wide, but in certain pockets only, the market is coming back so fast and so strong. You can see it in auction clearance rates. You can see the amount of offers that are coming through on some of these good location, good properties. So it's very interesting. I totally agree that last place or the second last place is not going to last for very long.
No, it isn't. And when we look at and of course, the little one down there, that's Darwin, which is the cheapest. But when we look at the annual change, and you can see there the changes that have occurred over the last year in Brisbane, Adelaide, Perth, still doing quite well. But when we go to the last quarter, there's Darwin, with a massive growth compared to the other capital cities. We've talked about this, Moss, haven't we? The fact that it's pretty much all investor and buyer agent driven. And I think it's a market you really want to be wary of. Darwin itself's only got about 140,000 people. It's smaller than Hobart, and it's highly volatile. Over half the people in Darwin are renters. So anything could happen.
It's crazy, right? Every time I jump on with a conversation with a client and they talk about NT and Darwin, and when I show to them the population forecast and amount of people that live there versus compared to the growth that is delivering, it's not that, the markets are rebalancing. It's purely investor-led and growth. And I always be wary of, the volatility that the investors bring on chasing yields in some of these places, right?
That's right. And we look at the last month, again, you can see now we've only got one capital city where there's been a tiny fall. That was Hobart. All the others in growth. And it's very unusual to see that sort of.
I know.
Yeah.
Yeah. I think that in my history, I've never seen all the cities at par when it comes to growth, except other than Hobart. And, there's not a lot of activity that happens in Hobart. But it's very interesting that not only the national average is the same, but also the regional average is relatively very same. Like, they're all growing at the same par. So it's very interesting as to how the markets are reflecting. And it's almost like I was talking about this to one of my staff the other day. It's like everyone is waiting at the start line and, they're jumping up and down to see as to who's going to take off. And I think we are at that point right now. So, yeah.
Yeah, very much so. So let's look at the forecast.
Now, one question that I do have, John, I've seen a lot of people asking this question is how safe it is to predict the market post 5-year mark. Like I know everyone talks about, the next 12 months, the next 14 months, the next 18 months, the next 3 years. How safe it is when people talk about predicting the market after 5 years?
I think we tried to look at periods of time beyond 5 years, and we discovered that there are simply too many things that can change, like interest rates can change, population growth, movement, demographic change can occur. So when you go out beyond 5 years, you're really in the realm of prophecy. You can't really predict accurately.
Yeah.
You can say that certain areas, certain suburbs have more stability, and that tend to be the areas where people buy family homes, they live in them a long time, so you find far less volatility in those sorts of markets. But that doesn't mean that the growth is going to, outpace the other areas.
100%. And I completely agree with that sentiments as well, that post 5 years, there's just too many variables to take into account. And anyone who's predicting the market, beyond 5 years to over 10 years is as good as finger in the air, basically, right? So
That's right.
they have no idea, they have no clue that the markets, from a long-term perspective, if you look at markets over 10 to 15 years, the market does what the market does, and you would see relatively that nothing changes much, right? So, yeah.
That's right. And you look at the comparative growth of capital cities, you'll find that, like at the moment, Brisbane's been booming, Adelaide, Perth, but in a few years' time, it could in Melbourne or even Sydney. So, things change, and it's very hard to predict, as you say, out beyond 5 years.
Yeah.
But in terms of what we've been doing over the last 15 years, our accuracy rate is over 90%, both for rent and price prediction. And that's both not just the direction of movement, but the actual intensity of the price and rent changes. So how do we do it? Well, when we look at the current market, imminent change, long-term change, we look at every suburb in one of 5 ways. So we say either it's experiencing strong growth, moderate growth, or falls, which could be moderate or heavy. And what that means is that anything which is strong growth means that the growth is over 10% per annum, and the heavy falls are more than 10% falls. We can't really say, look, it's going to be 20% or 30%. What we can say with a relative degree of accuracy is it could be over 10% or the falls could be over. And then you can see in between moderate growth, moderate falls, that's up to 10% either way. And a balanced market obviously doesn't move at all. When we then look at a typical city, this is a hypothetical city, and what we do is we gather up all the suburbs and say, how are they performing right now? Thank goodness this is not a real city, because you can see the black heavy falls, nearly half of the suburbs experiencing falls of over 10%.
Could be Darwin in a couple of years. Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages, or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years, and there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches, and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
Well, I hope not, but yeah, it's possible. A year from now, you see here that the wedges have changed. So there's a lot more red, which means suburbs predicted to have strong growth, still some with heavy falls, but it's far more even. And then we look ahead, say 3 years from now, and we see that nearly half the suburbs in strong growth. So that could be Melbourne, and for all we know. But what it means is that you can see, but just by looking at these pie charts, we'll look at the wedges, the colours, and how big they are, because that's telling you how many suburbs are experiencing strong growth or heavy falls, whatever. So now I'll look at each of the cities in turn. There's Sydney. So this is what's going on in Sydney right now. You can see a few suburbs experiencing heavy falls, but there's some with strong growth. And these suburbs are all at the lower price end. They're first home buyer suburbs. That's where all the growth in Sydney is occurring right now. And the moderate growth, they're all first home buyer suburbs. And the reason is we've had interest rate cuts and confidence has returned to the market. So more people are starting to become first home buyers. And even though the RBA kept rates on hold, and we were going to talk about that, my view is that they'll be forced to make an even bigger cut because they delayed at the wrong time.
100%.
We saw the labour market is weakening, so unemployment's up a bit, and I think they'll be forced to make a 0.5% cut in the next month or two. What that means is even if they don't, we can see that more suburbs in moderate to strong growth in Sydney a year from now. So half of Sydney's suburbs will be in growth, but again at the lower priced area of the market. 3 years from now, improving, so it'll be just over half. So looking pretty good for Sydney for overall moderate performance.
Yeah. One of the things that people always question about Sydney is compared to where the average wage sits, for families and couples and singles versus where the price sits. How much more can people afford, right? And that question keeps coming back as to why would there be more growth in Sydney when people can't afford such big mortgages. But one thing that they don't really think about is the impacts of rates coming down and the serviceability buffers, and how does that provides more disposable income to people working through, right? So yeah,
that's right. It's still, when we look at our database and we see those outer western suburbs, around Blacktown, Penrith, those sorts of areas, which are fairly affordable. I mean, they're over $1 million. That's where all the growth is concentrated.
100%.
Yeah. So looking at Melbourne, no red, but there's quite a few suburbs in moderate growth. And where are they? Well, again, they're the first home buyer suburbs, the outer suburbs of Cranbourne, Pakenham, uh, Melton is another one where there is moderate growth occurring right now. And we can see in our database that that's going to accelerate, and there'll be some suburbs with strong growth. Again, they'll be the more affordable suburbs. And 3 years from now, that growth will increase as well. So nearly half of Melbourne suburbs will be in moderate to strong growth.
And is it fair to say, John, that, because this is the data based on where the market is sitting right now, with the rate cuts literally around the corner, this could be amplified. The reds could be, seriously amplified from 1 year down the track in, majority of these areas?
Yeah, definitely that's the case. What we try to build that into our database. So we look at things like population growth, demographic change, and affordability. But yes, if rates say they went down more than what we anticipate, then of course the growth would be amplified. More people coming into the market able to borrow more. So this is pretty much based on what we know is going to happen, rather than what could happen over the next year, which, as you say, could amplify things dramatically. Brisbane right now, well, it's a pretty solid market with nearly a quarter of the suburbs in strong growth. But the difference between Brisbane, Sydney and Melbourne is that all the growth is now in the top end of the market. So the more affordable areas such as Logan, Ipswich, all of those markets, the growth has been going on for 3 years, and now it's upgraders moving into the better suburbs, and that's where the growth is pretty much concentrated.
Yeah. And what median price point are we talking about when you talk about better suburbs? Are you talking about like sub-million price point?
Over $1 million in Brisbane.
Yeah.
Because Brisbane is now the second dearest city in which to buy, a house. And yes, you're looking at all those high growth suburbs of over the $1 million mark, and they're not first home buyers, they're savers. Yeah.
I think when I look at on the ground reality, a lot of the suburbs that are trickling just around $1 million mark, there is some serious competition happening there, because people who can't afford 1.2, 1.3 million and can only afford up to $1 million, they are the one who are being really, really active in that space. And it's also pushing the opportunities for developers as well, because if they're bringing out new products out there, there's a lot of first home buyers grants, news that is coming through, federal government and state government as well. So there's a lot that's happening in that space in Queensland as well.
Very much so. And it's also, when we look at the spread of prices in Brisbane, it's what I call the most egalitarian, it's a hard word to say, egalitarian city in Australia, and that is there are more suburbs around the median price in Brisbane than there are in other cities. So, when the growth occurs, it's spread out far more evenly, and more suburbs can experience that growth.
And so would you say that Brisbane is the developer's heaven right now, and people who are aiming to do developments, they should be aiming for Brisbane, because that's where the high-end markets are, and that's where the owner-occupier, majority of the owner-occupier, expensive owner-occupier activity is?
Yeah, very much so, Moss, because what happens is that if you haven't had price growth occurring for quite a long time, it becomes unprofitable to undertake property development. When you've had a lot of price growth and prices have gone up, it actually makes it more profitable. You can compete with established properties. So right now, say in Melbourne, development is very difficult because there's been no price growth, and people can't compete with the cheaper suburbs, the property prices there. But in Brisbane, that doesn't occur. There's been a lot of growth, a lot more opportunities for developers. And of course, there's a lot more space for Brisbane to expand as well. It's not hemmed in the way that Sydney is, or in Adelaide. It's got room to move, both north and south, and that's what's happening. So 3 years from now, again, there's no black anywhere to be seen. It's all good, strong growth, moderate growth over half of Brisbane suburbs. Adelaide is again very similar, because we've had 3 years of really strong growth, and it's now all concentrating into those more expensive suburbs, the upgrader and final home buyer type suburbs. So they're the ones that are experiencing strong growth right now, and that's going to pull back a little bit. So even though well over half of Adelaide's suburbs will be in growth, there'll be less with strong growth, and again, they'll be the more expensive suburbs. and the growth will moderate again over 3 years from now. And there's a little black wedge as well, because some suburbs may go backwards. Not very many, but
Yeah.
still over half moderate to strong growth. Perth is again very similar to Adelaide and Brisbane. It's at the same stage of its market phase, in that the growth is now pretty much all concentrated in the higher price segments. And when we look at those affordable areas, or less expensive, like Mandarin, Rockingham and so on, the price growth has pretty much slowed right down.
Yeah.
And 1 year from now, so there's a bit of black there, and that would probably be those lower priced areas, but it's no real cause for concern. People who say the market in Perth is about to crash don't know what they're talking about. There's still huge shortages of rental properties. There's not enough properties being developed. We've got massive population growth, both from people coming in from overseas, but also coming over from the eastern states. So there's a huge shortage of properties. It just means the growth will be less dramatic than what it has been. And when we look 3 years, you can see there nearly half of the suburbs in growth, but most of them will be moderate growth, not strong growth.
Yeah. And so this is, Perth basically going into mature growth cycle, right? It's seen boom, 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 and now it's basically going more towards mature growth going forward, right? So
yeah, which is good, because Perth's been, the city that's had sort of boom bust type situations. They had a huge boom back in 2010 to 12, and then it all ended, and there was no growth for 10 years. I can see the market being far more stable going forward, which is good news. If if you live in Perth, you don't want that volatility.
100%, definitely.
Okay, now we're going to look at my boom predictions, and what I'm going to do is look at the main dynamics that are occurring right now and what they mean. And the first thing is we're experiencing massive population growth, and I'll show you here. These are the latest Bureau of Statistics figures that show we're going to receive 400,000 net overseas arrivals. Now, that when I say net, it means that a lot of people come here and they leave again, but these are the people, that's the net increase in population from overseas arrivals, complemented by about 100,000 natural growth, so 500,000. Most of our population growth will be coming from overseas arrivals, and most of those will be renters. Now, we have a look at the supply side.
Yeah. The other important thing that I've also noticed is that the way the vacancies versus the demand is coming through, like there's a massive mismatch as to where the vacancies are versus where the major demand is as well. So, and that amplifies the problem, right? Because you might have vacancies in Rockbank, but the demand is in southeast of Melbourne, for example. And that creates even a double whammy, because, while the rents are still going up, because, the demand never catches the supply. It's a very interesting dynamic at play. And so I completely agree. I think the rents are going to go crazy across the board in pretty much every state, especially like major city centers.
Yes, they are. So what we can look at is, well, where is this going to occur? And you said major city centres, especially Perth, rents will keep on going up there, Melbourne, Sydney and Brisbane. So the major capital cities is where that growth will be concentrated in rent demand. And to give you an example of how we look at different markets, I've picked a few suburbs here, and this is Meadow Heights, which is up in north of Melbourne in the metropolitan area.
Yeah.
When we look at Meadow Heights and we go to the census data, so this tells me what people's cultural heritage is. And the way I do that is I look at the language used at home. So if people don't speak English, what language do they use, which tells me where they've come from, their ethnicity. And when you look at Meadow Heights, this is the Census 2021 data, which is the latest we've got. And you'll see there, it compares the number of people and the percentage compared to Victoria as a whole. So there's huge numbers of people who speak Turkish, Arabic, Assyrian, and fewer with Vietnamese and Urdu. Now, what that means is that this is during the census, of course, during the lockdowns. Since then, we've had these massive number of people coming in, and where are they likely to go? Well, they'll go to areas where they feel more at home, more comfortable. And if they're, say, Sunni Muslims, that's where they'll go to suburbs where there's a lot of other Sunni Muslims, mosques. Like Meadow Heights is a good example of that. So what's going to happen if more people are coming from areas such as Lebanon, which we expect that will happen? The rent demand is going to increase dramatically in Meadow Heights. So now we have a look at the actual data. This is PropTrack data, which I've just copied and pasted. So you can see Meadow Heights. You can buy a 3-bedroom house in Meadow Heights for $600,000, and it only went up 3.8%. That graph down the bottom is the 5-year graph price history. So it hasn't really, gone up much at all. But now let's have a look at the rent, and this is the rent, $517 per week, and it went up for a 3-bedroom house by 15% in the last year. So you can see how much rents are increasing compared to prices in Meadow Heights.
Yeah.
What will happen? Well, 15% rent rise, that's going to continue. That sort of increase is caused by the number of people coming in wanting to live in Meadow Heights and rent. And so this is going to become incredibly attractive to investors who will look at this and say, wow, the rents are going up dramatically. If I'm after cash flow, this is where I buy. And so Meadow Heights, of course, the property market there will boom because of the number of investors coming in to provide the rental accommodation for the people in Meadow Heights.
Yeah.
Here's another example. I'm sorry, you're going to say something, Moz?
No, I was just thinking, how important, and I think it's an interesting comment that you make, that it also depends on where people are coming from. Like, you wouldn't expect, people coming in from Asian countries living in Meadow Heights, for example, right? They would be more targeting towards more Asian denominated, suburbs like Chatston or Point Cook, when it comes to Melbourne, because, they wouldn't want to live in, some of these localities. And the character of the suburb matters a lot as to,
Yes.
where the immigration is coming from as well. So it's a very important point.
It is. It's extremely important. Here's an example for Dandenong units. And again, I've gone to the census to have a look to see, well, what language. And I think the first one is
Hazaragi, yes.
Harazagi. That's, I think people in Afghanistan speak that.
Yes, yeah, they're actually from Hazara.
Right. So you can see huge percentage compared to Victoria as a whole. Albanian, Dari, Punjabi is different culture entirely to Meadow Heights.
Yeah.
And if we're going to get more people coming in from, say, Afghanistan and those sorts of places, then of course the rent demand will escalate. And when we look at the market, the unit market, this is quite unbelievable. A 1-bedroom unit is the median price is $285,000. It only went up by 1.8% in the last year. But now look at the rent, and you'll see that the rent is $390, and it went up, and this is official PropTrack data, by over 18%. So rents are shooting up dramatically because all these people are pouring into Dandenong and they want to rent a cheap unit.
Definitely. I think, single population and this, people who are trying to aim at single dominated market. I'm talking about, single parents, single people, single students, single income earners, etc. Or even a couple, renting out a bedroom. That is the biggest market and the biggest intake. When you talk about household splits, one of the things that I realized is, they take, I think, about 27-28% of the household split, just in Victoria. And I think that's very similar in all different states. And you're seeing continuous pressures building up in household type of single denominated people. And so it's an interesting fact when you talk about, okay, these rental pressures that are building up, that's going to be translated into the pricing pressures because, the demand for investors coming in quite quickly. But one question I'm going to throw in, a curveball question here, is when you talk about owner occupier, the real demand or the real growth typically comes from owner occupier growth and not so much investor led growth. A lot of these people, from the type of the countries that they're coming from, they're not coming in with buckets of cash in their hand. But of course, they will buy in these locations knowing that the rents are so high and the mortgage might become, very at par to the rental side of things over the next sort of 1 to 2 years. So are you talking more from a short to medium term perspective as well, where the increase in rent happens and then the owner occupier demand creeps up over the next sort of 12 to 18 months as these people start entering into, the buying mode?
Yes, exactly. And I'll point that out in the next few slides, exactly what you just alluded to. It's very correct, and I can give you an example of how that works. So in Dandenong, one-bedroom unit under 300,000 to buy, and you're getting over 6% yield. So excellent opportunity there. And our database is predicting that strong imminent growth. But as you say, it's not going to be a long-term investment opportunity. It's more for as long as people keep coming in and generating rent demand. So let's have a look now. This is Bankstown in Sydney. And very, very different ethnic makeup. Vietnamese, over 20% that's the language used at home rather than English. So,
Wow.
yeah, there's a lot of Vietnamese people living in Bankstown.
Never knew that. I thought Bankstown would be very Arabic oriented, and you would see most, that the highest language spoken would probably be Arabic or maybe Persian. I don't know.
Yeah, it's second highest. The Vietnamese is still the highest. But these people came here a long time ago. They've been living exactly what you're saying. When they came, they were renters. And then when they decided to buy a property, they said, well, we love Bankstown. We know this area. We're going to buy a property. So when we look at the PropTrack data, this is the situation for rent in Bankstown. Hasn't moved at all. Yes, it's flat. So not like Dandenong or Meadow Heights where the rents have been escalating dramatically. No, they haven't, because people aren't coming here from Vietnam anymore. So that they're going to other, different ethnic people will go to other locations, different ethnicity. They're not moving to Bankstown. But what about the house price? Look at that. It's 1.5 million and it went up 18% in the last year. So those people who came here 10, 20 years ago from Vietnam, for example, are now buying houses in Bankstown. So buyer, exactly what you said. And this is an example of how that works. So the rent demand flat, but buyer demand is increasing dramatically.
Yeah. And I think a lot of people don't take lag into account. They think that, they treat property market as, share market, right? Or the rent goes up, the price goes up, whereas that's not really the case. I mean, it is the case, but it doesn't happen like quickly. There's almost like 2 to 4 years lag in rents going up versus the price demand coming through.
That's right, exactly right. And it means, let's say we look at Melbourne, where we've got 140,000 people came in from overseas last year alone, nearly all renters, but they're going to become first home buyers in 3 to 4 years. And the question is, well, where will they buy? And depending on where they've come from, it might influence where they want to, to be homeowners. So, but generally it does mean, yes, the demand will increase dramatically.
100%.
Problem we have, Moss, is not enough new homes are being built. And this slide, I think I've used this before because it's so dramatic. It shows you the annual completions required to meet demand from population growth. The annual requirement is about 270,000 homes. That's the green line up the top.
Yeah.
The yellow line is the annual completions required to meet the National Housing Accord target, which is 1.2 million homes over 5 years. And the Treasury, they released under Freedom of Information, somebody asked the right question, and Treasury said there's no way known the government can build 1.2 million new homes in 5 years unless they dramatically increase taxation to pay for it.
Yeah.
So, they're not going to make it. And in fact, they're not anywhere near. You can see down the bottom, the blue columns are what's actually happening and predicted to happen. So the housing shortage is going to get a lot worse.
100%. And I think one thing that a lot of people don't realize and understand is that, no matter how much the government incentivizes first-home buyers in going out there and, trying to, incentivize them to buy more houses, if the developers are not incentivized to bring out new products, the housing crisis or the developments would never, rock up and turn up anyway, right? So it would just put the pressure on putting the house prices more rather than creating more supply.
That's right. That's exactly what's going to happen. And here's an example. This is in Melbourne again, Carrum Downs, which is a beautiful bayside suburb of Melbourne. And what I did there is I looked at, this is the median sale price, 722,000, only went up 4%. But when you look at the bottom, you notice, and this is some of the indicators we use in our database, we compare the demand to the supply. And PropTrack gives us this information. When you look up a suburb in realestate.com.au, you can simply go to the PropTrack data and you'll see these sorts of numbers. And what they're telling us is that the demand is far outweighing the supply of properties in Carrum Downs. The relationship, when you look at the ratio one to the other, it's about 10-1, which in our database predicts strong price growth for Carrum Downs. And you look at the median time on market, it's come right down. So that market is going crazy.
Carrum Downs, Patterson Lakes, Bond Beach, all of these locations. Like, I think they, not only the love for water is there because they're right at the peninsula, but also the access to amenities, access to the city, everything is quite central. So, and people who've lived in Melbourne for over 15 years, they would know this, that, Carrum Downs, Frankston, Chelsea, all of these areas had a really negative kind of connotation attached to it. People used to think about, oh, junkies live there, and people with low socioeconomic impacts live there. But you go to Carrum now, you go to Patterson Lake now, you'll find like $3 million, $4 million houses there, close to the beach. So the dynamics have changed dramatically in some of these locations.
They have, and a lot of people want to live there for all the reasons you've mentioned. It's a very highly desirable part of Melbourne to live in. And, you can walk to the beach and you can buy a house there for, $722,000. It's quite extraordinary. So when we look around Australia at what we call the shooting stars, these are the areas where that shortage of housing is most pronounced. And we can see in Melbourne, as I mentioned, the Bayside suburbs, also the outer suburbs, Pakenham, Cranbourne, and Melton, those sorts of areas have got huge price growth potential over the next few years. They're not building enough homes. Even when we look at our database, and Geelong, the cheaper suburbs in Geelong and Bendigo have all got strong price growth potential. And quite frankly, if you can buy a house in Geelong for under $500,000 or in Bendigo for about the same price, that can't last. That's going to go up dramatically.
100%. And it's interesting, I think Geelong, when you talk about Geelong again, water around, and you have one suburb that is selling for 1.2 million, and then you have the next door suburb selling at 500,000. I was like, geez, like, how does that happen, right? And it just says a lot that, it's, as the owner-occupier demand would shift and people can't afford, certain areas, they will naturally move to the neighboring suburbs. And what we call it is the ripple effect that would happen in a lot of Geelong as well.
Yes, and it's certainly about to occur there, and in Bendigo as well, and also in Sydney's outer western suburbs, where you can still buy houses under $1 million, and it's possible around Bankstown and those sorts of areas, which again had connotations. They had a bit of a reputation, but that's all changing now. That a lot of these areas have been refurbished and gentrified, and that's where the growth will be concentrated in Sydney. And also in Brisbane, we look at the markets there again, because of that huge pressure from population growth, not enough properties being built. So these are the markets where the growth will be more pronounced.
Definitely. I'm going to throw some curveballs at you, John. RBA not dropping the rate, APRA not changing the serviceability buffer. What do you feel? Like, should they have cut the rate? A, B, when is that going to happen, and how pronounced it's going to be now?
I think what they've done is sort of the RBA. I look back at the history, and a long time ago, the RBA was freely, putting in rate cuts of 0.5% and more. It was quite common, or even increasing rates by the same amount. And they just seem, since 2012, they haven't done that. They've only been decreasing them by 0.25%. Or even less on once or twice. So I think that by delaying it, they sort of forced themselves to have a bigger rate cut when it occurs. So if it's next month, they might have to cut rates by 0.5 percentage point. And I think that that's something that they will simply not be able to avoid doing. And that's going to provide a big impetus to, the first home buyers and investors into the property market.
Yeah. And it's important to understand the implications, right? It's better to not wait for the market to, tap out. It's better to basically enter in now before the floodgates open up. My feeling, I completely agree with where you're coming from in relation to RBA should have done the rate cuts, but it's almost like a double whammy, right? They understand as to where the market is going to hit to, and, they are seeing the housing prices, they're seeing where the rental demands are, they're seeing that there is not enough houses available. And so every rate cut would change the dynamics of how the housing market operates. And so they've almost like backed themselves in the corner where they're like, oh, if we don't do a rate cut, there is, recession that is looming around. And if we do a rate cut, then the market comes back quite significantly. The interesting bit is this, right? And I think technology plays a really, really big part in twisting RBA's hand. That's what my take on it. This is that, especially with people talking about AI, jobs disappearing, outsourcing opportunities, etc. That is all coming through Australia per se. You would see that, this is the first time people are talking about technology-led recession, and how real this is and how fast this is going to come through. I think that's what's going to dictate, and clearly RBA's eyes on that too, as to okay, we don't want to do it too much where we give too much rate cuts and then this recession comes in and then they have no lever to pull, right? The car is basically out of the cart completely. So
yeah, I think they're being very, very cautious. But I don't think AI is going to cause massive job losses. I think what it does, and technology has done this in the past, it simply transfers people's skills from one set to another. So people change, the way they work, what they do.
Yeah.
When you think about 20 years ago, people didn't use computers at all, and now everyone's using computers in their daily work. So, that's just created more opportunities in different areas.
100%. I think I was listening to Bill Gates on one of the podcasts, and, the interesting fact that he commented, and I don't think that I agree or disagree, it was just the fact that, while internet or computers came in and, created more jobs rather than doing less jobs and didn't really bring in the recession, the switch of the employment market, like the upskilling of the employer or employees when the AI transition comes in, is going to have a bigger lag. And so you can't you can teach a person to, use a computer in 3 months' time, right? But you can't teach a person to code for AI in a 3 months' time. And I think that's where people are alluding to that, the lag might be big enough for the market to take a slight dip before it starts coming back up. And so, of course, there would be more jobs, but it's the transition and the impact that it takes on the type of the age brackets, right? And so people who are, say, for example, in the 50s who are trying to transition into new roles, they might feel that, okay, there are not enough jobs available, they don't have enough time or the appetite to basically go into some of this space where it requires a lot more creativity and learning a completely new language, etc., all of that. So interesting space to watch out for, I think. So yeah,
very much so. And I agree entirely. There will definitely be an increase in unemployment as a result of AI, and there will be that lag before people can retrain. And we've seen that in other industries that occurs. I've got a property down in Tasmania, and a lot of people were employed in, say, timber felling, timber cutting and all that. A lot of that stopped. And so these people are now being retrained in tourism because that's the new industry. Well, that takes time. You can't become a wood chopper one day and a tour guide leader the next. So it all takes time.
Thank you very much, John. And for your viewers and listeners, if you have comments, feedback in relation to what you think is the market's doing, or do you agree or disagree with the RBA's decision of interest rate cuts, or you have different perspective around whether RBA should or shouldn't cut interest rates, drop into the comments below. If you want to reach out to John or myself, you can reach us out to info@helpmeby.com.au as well. We can always put you in touch with John. Thank you for listening to us today. Thank you very much, John. Take care, stay safe, keep smiling, keep investing. This is John and Moss checking out. Adios.